Welcome to Max Mortgage's Introduction to Reverse Mortgages. Today, we will provide a reverse mortgage overview, product specifics, and some real-life examples of how these mortgages can positively impact seniors' retirement experience. Let's get started with some reverse mortgage basics. So, what is a reverse mortgage? Simply put, it's just a mortgage specifically designed for older Americans, allowing them to convert or leverage a portion of their home's equity and have flexible repayment options, coupled with an insurance component, making it a non-recourse loan. In order to understand just how a traditional or forward mortgage is similar to a reverse mortgage, let's take a look at the components of the two products. Just like a traditional mortgage, a reverse mortgage is simply a lien-on title. The borrower maintains home ownership. There are no prepayment penalties. There are comparable rates, and all borrowers, regardless of product, are responsible for paying their property taxes and insurance. As for the differences, which are honestly benefits of a reverse mortgage, there's a no minimum FICO score requirement. The loan is a non-recourse loan, meaning the borrowers and their heirs will not owe more than the home is worth at the time of repayment, and there are no required monthly mortgage payments or set terms. Now, you may be wondering, why is this product not used more by senior homeowners? Well, we wonder the same thing. The bottom line is that many borrowers and even industry professionals believe the myths over the facts when it comes to this product. Education is key to helping seniors utilize home equity to better their retirement. So, let's go ahead and debunk some myths. Myth number 1. The borrower gives up their ownership of the home. I'm sure you've all heard this before. As mentioned earlier, the reverse mortgage is simply a lien-on title. By providing optional monthly mortgage payments, the risk of losing the home is not linked to the borrower making those payments. The borrower is simply responsible for maintaining the home and paying property taxes, insurance, and any HOA fees. Myth number 2. A reverse mortgage somehow locks a borrower into their home for life. This is simply not true. Just like a traditional lien, the homeowner can sell the property, pay off the lien, and any remaining equity goes to the borrower or homeowner. They can refinance at any time, and there are no prepayment penalties. Myth number 3, the heirs will be responsible for the debt. This is an interesting myth saying that all mortgage debt is passed on to the heirs, regardless of if you have a forward or reverse mortgage. The difference here being that with a reverse mortgage, they will not be responsible for more than the home is worth. Myth number 4, reverse mortgages should only be considered as a last resort. We have heard this many times, and the fact here is that this is a stereotype, and it has been debunked by countless retirement planning scholars and professionals. When using a reverse mortgage as a proactive financial planning tool, retirement outcomes can be greatly improved, and safety nets can be put in place prior to life events to prevent financial stress. Myth number 5, the borrower cannot refinance a reverse mortgage. Not only can borrowers refinance their reverse mortgage into a traditional loan, but they can also refinance it into another reverse mortgage as their home appreciates and they get older, which can allow them to access even more of their home's equity in the future. These are but a few of the myths that are circulating, but there are many more myths that hold no value. The FHA has streamlined refinancing. As they credit their mortgage insurance premium for the original transaction, this makes refinances not only possible, but less expensive for senior homeowners. So, when talking to potential borrowers, many are curious on how the available proceeds of the reverse mortgage loan are calculated. There are 3 main factors used to determine how much money can be borrowed. Number 1, the age of the youngest borrower or non-borrowing spouse. Number 2, the property value up to the maximum allowed by product type. Number 3, the current interest rates. Once it is determined how much can be loaned, then available proceeds can be calculated by first paying off all mandatory obligations, including liens, closing costs, loan fees, and any additional debt required to be paid, such as delinquent federal debts, any required property taxes, flood or hazard insurance payments. After mandatory obligations are paid, the remaining proceeds can be distributed in a lump sum, monthly disbursement, a line of credit, or any combination of these. So just like other mortgages, a reverse mortgage is a loan, and it must be repaid. However, unlike other mortgages, a reverse does not require repayment until the homeowner either sells the home, no longer occupies the home as their primary residence, does not meet the terms of the mortgage. For example, they do not maintain the property, pay property taxes or insurance, or the last surviving borrower passes away. When the loan does become due and payable, the reverse mortgage and any accrued interest and mortgage insurance for HECM must be repaid. However, it is important to note that the reverse mortgage is non-recourse, which means that the borrower will not have to repay more than the home's current market value at the time of repayment. All remaining equity in the home at the time of repayment goes to the client's heirs or the estate. So now that we have a good understanding of the reverse mortgage and we've debunked some myths, let's highlight some of the extensive consumer-focused benefits of the reverse mortgage loan program. First, there is counseling. All HECM reverse mortgage applicants are required to undergo third-party counseling with a HUD counselor. Borrowers will be provided with a list of HUD counselors to select from. This is done so that the borrower understands all of their options and they can feel completely comfortable with the process. Second, there are no prepayment penalties. The borrower can choose to repay the loan at any time, and they will not incur additional costs for doing so. Third, the loan is a non-recourse loan. As we've mentioned before, it protects the borrower from being held liable for the loan beyond the value of the home. The borrower's financial obligation to the lender will not be more than the home's value when the reverse mortgage loan becomes due and payable. Lastly, what we're covering here is the life expectancy set-aside add-on. When a LESA is not required, the borrower can choose to get one to cover their taxes and insurance premiums, so they don't have to worry about missing a payment. We should note that a LESA is not available on all reverse mortgage products. So now that we understand the basic reverse mortgage concepts, let's take a look at the key differences available by product type. A home equity conversion mortgage adjustable rate is the most commonly used FHA product in the market. This loan can be used to either purchase a home or to refinance the HECM ARM. It offers the most flexibility and how the proceeds can be delivered post-closing, with the key feature being the line of credit option. The line of credit will grow at the same rate as the interest accruing on the loan amount. The line of credit can be accessed at any time after the initial 12-month period from the original loan disbursement. The initial draw amount can be paid down at any time to increase the available funds in the line of credit for future draws. The product also offers 10-year or lifetime payments, term payments, or a combination of these. Next, we have the home equity conversion mortgage fixed rate loan. This can be used also for both purchase and refinance transactions. The main difference here is that the borrower must draw all available funds at close, and there are no future draws available. The loan is typically used when paying off larger loan balances, and all available funds are being utilized at the time of closing. So, now let's take a look at these products in action. In this example, we have a 73-year-old borrower with a $250,000 home and a current mortgage of $40,000 with a HECM line of credit or a HECM ARM product. After paying off his mandatory obligations, that being his mortgage lien and closing costs, he would have $51,887 left in a line of credit. After 10 years, if he made no payments to the loan balance and did not draw additional funds from the line of credit, the line of credit would grow to $101,716. That is an additional $49,829 just for letting the line of credit sit there. This borrower eliminated his mandatory monthly mortgage payment and created an available line of credit that's growing. Now that we are really getting an idea of how a reverse mortgage works in the real world for senior borrowers, let's take a look at more benefits of a reverse mortgage. In retirement, here are some other ways a reverse mortgage can positively impact retirement outcomes. 1. It can create financial security. 2. It can increase cash flow. 3. It can help retirees maintain a healthy financial portfolio. 4. It can be used as a means to meet long-term care needs. 5. It can give the borrower the ability to purchase a second home. 6. It can contribute to overall financial flexibility and freedom. So how does a reverse mortgage help in reaching those goals? First off, a reverse mortgage offers several options for ensuring longevity of the borrower's retirement assets. Secondly, it provides financial flexibility and peace of mind in an unpredictable market. Thirdly, it allows the borrower to use their home equity as part of their financial planning strategy. Borrowers should always speak with their financial advisor about their specific financial needs and goals. So, when it comes to a reverse mortgage, there are usually 3 main drivers that lead a borrower to obtain a reverse mortgage. Let's go ahead and take a look at those 3 things. 1. First up, we have the immediate needs borrower. This kind of borrower is looking to solve an immediate need, something like eliminating their monthly mortgage payment or accessing cash to help the borrower maintain cash flow and pay for unexpected expenses. 2. Second, we have the borrower who wants to fulfill a want. This motivation could be as simple as wanting to travel, renovating their home and getting a brand new kitchen, or helping pay for their grandchildren's education. 3. Lastly, we tend to see borrowers who are looking to get a reverse mortgage as part of their retirement financial planning strategy. From eliminating the need to pull from their retirement accounts in a down market to creating a financial safety net. Well, that was a lot of information, and we're going to wrap this up with some of the highlights of reverse mortgages. First highlight being that a reverse mortgage can eliminate required monthly mortgage payments for American senior homeowners. 2. Second highlight is that a reverse mortgage borrower retains ownership of their home, and the loan is similar to a traditional mortgage, but it comes with optional monthly mortgage payments. 3. Third highlight is that through products like the HECM ARM, the reverse mortgage provides access to the home's equity and can have key features like a growing line of credit. 4. Finally, the reverse mortgage is a non-recourse loan. The borrower and their heirs will never owe more than the home is worth when the loan becomes due and payable. That wraps up our introduction to reverse mortgages. We hope that this has been informative for you and that you have a good foundational understanding of this product and how it can help you with your financial planning. If you have any questions or you think you might benefit from a reverse mortgage, please reach out to us at any time so we can prepare a personalized reverse mortgage quote to see if it makes good financial sense for you to do. Thank you for watching.